Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 266 for June 8th, 2020. We are recording this at 1 p.m. Eastern Time. My name is David Cosmitter. I'm the creator of TimingResearch.com, and today we are going to be talking about the S&P 500 and what everyone thinks is going to happen in the markets this week. So today I have arranged for Carley Garner, Amelia Bourdeau, and Jim, the option professor, to be here. And Jim will be moderating, so I'm going to go ahead and turn it over to him.
Okay, great. And happy Monday, everybody. Good to have everybody back. Markets are pretty strong here today on the indexes. And so we'll hear a lot more about what's going on from the guests today. First up is Carley Garner of DeCarleyTrading.com. And we also have Amelia Bourdeau of MarketCompassLLC.com. But first up, Carley, could you just quickly introduce yourself to the people who are not familiar with yourself and also what's happening at DeCarley Trading?
Sure. So I am a futures and options brokerage. Well, we are a futures and options brokerage firm, I should say that. We're kind of a boutique shop. We're not huge, but the idea is we're small and we can give much better service. We specialize in options on futures. We house short option trading accounts as well as option spread accounts and even some futures trading accounts.
Okay. And at the end of the broadcast, you can let people know how to get a hold of you and how they can get some details on what you're up to.
Sounds good.
Okay. Amelia, a little background on yourself and also what's happening at MarketCompassLLC.com.
Thank you, everyone. Hi, I'm Amelia Bourdeau, and my background is mostly institutional. So I come from Wall Street. I was on Wall Street in various capacities for 17 years. I started at the Federal Reserve Board, and then I moved to two of the world's largest foreign exchange trading banks. So at the time, Deutsche and then UBS. And then I was at a couple hedge funds, and then I became a foreign exchange sales trader myself at both UniCredit, AGA, and Westpac. And I left those days behind a couple years ago to start Market Compass LLC. And we interact and we teach strategy. We give strategy, and we teach investing and trading to really investors at all levels, but it's geared more towards the individual retail investor. And I take a top-down macro approach to markets. My specialty asset class is foreign exchange, but we do look cross asset class. And then Market Compass also has another consulting arm, and I actually consult for some Wall Street hedge funds as well in the background. So it's good because I still have a connection into that world, and I kind of know what they're doing and focus my retail trading on that.
And at the end of the broadcast, of course, people can get a hold of you and get more information on what's happening as well, right?
Yes, I will get those details out.
Okay, we have some standard questions we ask on Mondays, and sometimes in the last 3 months, they seem like ridiculous questions. And the first one is, what do you guys think the market will be between today on the S&P, where we opened, which was 3199, so let's call it 3200, and Friday's close? Do you have an opinion or do you have a feeling for that, or is that outside your realm? Let's start with Carley.
Sure. Okay. So obviously everybody's wondering how high is too high in the S&P, and your answer is probably just as good as mine. We have no idea. The next technical resistance we're looking at is 3250. I do think we'll see that this week. If there's any sort of bearish tendency at all in the market, it should at least pause there and maybe pull back for a little bit. We tend to be, we're looking for like 3,600 on the upside at some point. Well, our original thought was by the end of the year, but it's happening a lot faster than we had ever imagined. I do think we'll see the 3,600 level, but I think probably the easy money has been made on the upside. It's going to probably start to get a little bit rocky here just because we've come so far so fast, but time will tell.
Yeah. And, like I say, that's the way the flow of money has been going, because everyone pretty much sold out. That advanced decline line was so dramatic, and the panic was so dramatic that obviously we exhausted the sell side. And so now people have to rebalance, and, that's what makes it keep going up. People are surprised at that, but that's pretty much what people are thinking. How do you feel, Amelia, about between today and the end of the week?
Yeah, I mean, I've told clients not to fight this risk rally, even if you don't agree with it clearly. I mean, it has legs, and as Carly mentioned, it's happening a lot faster, than most analysts across Wall Street thought it would happen. And it's just on the up and up. I mean, that's not to say that a headline can't come out of somewhere and we'll have some down days on a negative headline, but so far the market has been, as I'm sure you all know, impervious to these negative headlines. There's social unrest going on. There's some negative headlines, especially that come overnight in the Eastern Standard Time about the U.S. and China back and forth, and headlines between U.S. and China really negatively impacted the S&P 500 back in 2019 when it was during the trade war. But so far, they haven't made a dent, in this risk rally run up. So it's just got legs. I mean, I think part of that has to do with the Fed indicating that, they'll do whatever it takes to continue to stabilize financial markets and keep them liquid. And we're also strangely and not strangely, we're getting a sentiment boost from the economy reopening. New York City, today is June 8th, so New York City opened, starting to open today in Manhattan. And I know, Carly, you're out in Vegas, and Vegas opened, right? They're already underway with seen the casino photos. So
There.
yeah, so that's a good sentiment boost. And so far, the market has not focused on social unrest. It's focusing on the opening of the economy. And as Carly said, I don't know how far it can run. I mean, I would think we're going to go back to the March highs of at least, near term, go back to the March highs of like the 33, like 80, 85, 90 level around there. And certainly it could go higher from there.
You came from a background with the hedge funds, and a couple of things that I've read was CME short interest was particularly high, and obviously that causes short covering. But also active managers, I had read, are underinvested lately. And do you agree with that statement from your background with the hedge fund guys? Do you think most of them have been underinvested, and that's also caused a FOMO type deal?
I think there was some. I'm a macro person, so macro hedge funds, macro analysts were like the doomsday preppers of the investing world, the trading world, right? We typically see what's wrong and what can go wrong first before we'll see what's wrong. And, I think most of the risk rally run up, as quickly as it happened, did catch a lot of the macro people off guard, because we were looking for a more extended decline when the shutdowns commenced. Having California shut down back in March which is the largest state economy in the United States, was just, pretty shocking. And I think as soon as they realized that, I don't think they're too underinvested now. I think they really started to pile back in when, the sentiment started to change. And I think the sentiment started to change when we got, when everything was shut in the United States, I'm talking, when announced, by the time California, Texas had shut, those are the two, largest economies, along with New York State and Florida. I think that was like the bottom. And then everybody thought, we're looking ahead to the next thing. And looking ahead to the next thing is reopening. Looking ahead to the next thing right now isn't a second wave, and maybe of coronavirus coming back in a second wave of shutdown. So the market isn't looking that far out yet. It's really just concentrating very optimistically on these reopenings. And I think, there's a lot of focus on the reopening stocks, like today, the airline stocks and Carnival lines and things like that are on the move. I think what's catching people off guard now is how, quickly people are traveling once again. I know people who've already, once their state restrictions were lifted, they've already taken flights. And I was surprised by that. And, maybe travel won't be as badly as affected for as long as we thought it was initially. So those are, sectors to look at too.
Yeah, the symmetry of the down move is being matched by the up move. Carnival's having a big day today, up 11%, but in reality, the darn thing used to be at $50 and it's still at half price.
Yeah, I mean,
So,
that kind of thing, you have to, from a macro world, you look at that We don't so much look at the technical levels, though. We're aware with that, the macro world, the call on like a Carnival cruise or the airline stocks is more of a big macro view. Like, do you think people will travel? Do you think there'll be a second wave? Do you think they'll be able to enforce state lockdowns and travel restrictions if there is a second wave? So we take those larger questions and we take a time horizon, and we would invest, off that time horizon and the answers to our questions. And as an individual investor, depending on what state you live in, you can probably see the answers in everyday life. That's why I think this is a interesting investing or trading case in a way, because, are you living in a state that was greatly impacted? Like certainly Manhattan was, when certainly my friends in London are still mostly under lockdown. But here where I am in Florida, almost everything is open again. So yeah, it depends on where you are and what your view is.
And they priced the epicenter stocks as if no one was ever going to go on a cruise and no one was ever going to rent a car. So, I found CAR, Avis Budget, a ridiculous value at 10 or 15 bucks. And, because people are acting as if you'll never leave the house and you'll never drive a car. So when you get that kind of panic, it's going to snap back,
Let me tell you something, just an interesting anecdote about me on that same topic right now. Just before I came on this webinar, my apartment is on the market in Manhattan. And, I listed it at the absolute worst time. It was like, it went live like 1 week before the shutdown. So there hasn't been, like, it was the worst ever. There's been no open houses, nothing can be held. It's completely locked down. You can't enter the building unless you're there. No one can come over and visit, no packages, nothing. So today, right before I got on this call, my real estate agent called me and he says there's 2 prospective buyers interested in it.
Yeah.
And that was shocking to me. Like, I was like, this thing isn't going to move. Like, no, I don't want to see this place for a year. It was shocking.
Now, real estate is actually doing quite well and at a brisk pace, which is surprising to people. But, like I say, life goes on and people are not going to, act as if the world had come to an end. Hey, Carley, you basically were saying, normally we ask percentages of confidence, but both of you seem to be pretty positive. The market is in a good trend and it could continue. So forget about the percent confidence, but what about what's behind the picture? Expound more on what reasonings you have that we could go up towards the 33, 34, 3,600 over time.
Sure. So there's a few things that we're looking at. For one, I think some people have missed. There's been a huge wealth shift from small businesses to large businesses, and the major stock indices are large businesses. So even though middle America and mom and pop shops are suffering, the big businesses are all benefiting from that. For example, when the government shut down the economies around the country, everybody had to stop shopping at the local stores and had to go to Costco or Amazon or, the bigger shops. And the same thing with restaurants. The mom and pop restaurants are either struggling to survive or out of business, and all of that money is flowing into the bigger names. So we've noticed that. We're also noticing the dollar has weakened a little bit, and just that alone supports stocks, with all else being equal, even if fundamentals don't change positively. So those 2 things, as well as seasonals. Most people, they're aware that seasonals occur in commodities like corn and things that are grown, but they tend to ignore them in the stock market. Stock market has definite seasonal patterns. The last several, it used to always hear sell in May and go away. That hasn't worked for quite a while now.
No, it hadn't.
It's actually the kind of the opposite. The summer, the light volume in the summer tends to support melt ups, which is exactly what we're seeing. Those melt ups usually don't really run out of steam until late summer. So with those things in mind, even though, the market's obviously a little overdone, maybe it pulls back in the short run, but the overall direction I continue to believe is going to be supported by weaker dollar, seasonals, and just the fact that big businesses happen to be in the right place at the right time.
You watched the different markets with regards to TLT seemed to hit a little bit of a low last week, and it seems to be trying to make a turn down here. Could that be an indication that TLT may have a little bit of a rally, and maybe 32.50 or wherever the 32.25 could also see a little bit of a dip? Is there any correlation you think between TLT and SPX?
The reality is the bond market, or at least the treasury market, has been in a world of its own. Like, as stocks are recovering, the interest rate market just hasn't hasn't really budged. We've been hoping for that to happen. We're looking for yields to move higher, and we trade the 10-year note, which is similar to the TLT, sorry. So we're looking for the 10-year note and the 30-year bond to roll over and head lower, pushing interest rates higher. But we've been thinking that's going to happen for a couple months now, and we've just really been at a stalemate. So my personal opinion is, though, yeah, the long-term trend has probably rolled over a little bit. It's hard to, I mean, I understand, like in 2019, the story was interest rates around the globe were so low that even the low rates in the US were not nearly as low as other rates. So it was kind of a bargain to put your money in the US and earn a couple percentage points. Now that we're under 1% on the 10-year, I don't think that money flow is going to happen the same way. And so I think that's going to put some downward pressure on notes and hopefully push interest rates up a little.
I'm going to get to Amelia in 1 second on this question because it's one of her specialties, but I was going to run it by you, Carley, real quick. I've been watching the dollar index, and my belief was that it was in a trading range of 101.99, and once it broke 99, school got let out. But there are some people even being stronger about the dollar, saying there's a secular downtrend to it that has started, and I'm not ready to go there. How do you feel about the U.S. dollar, Carley?
I do tend to believe that the dollar is probably, I think it's seen its best days, let's put it that way.
Okay.
I do think that there's a decent chance we break through into the 80s and maybe even the low 80s at some point. And the reason I think from a fundamental standpoint, the dollar is no longer going to benefit from the interest rate differential it has over the last couple of years. Also, it's in my opinion, we've been too high for too long. The dollar's been trading in the 100 area for so long, everyone's kind of started to think that that's normal, but it really isn't. If you look at a long-term chart, it's actually abnormal. And the last time that interest rates were not as low as they are now, but actually pretty close to, like, if you look at the Fed funds rate, the last time the Fed funds rate was down in the area that we're seeing now, the dollar index was in the 70s. So to me, it seems logical that we head down there. I'm not sure we see the mid to low 70s like we did 2008, 2009, but I think the mid to low 80s is possible.
Yeah. The dollar index was so stable for a while, I was starting to call it the Hong Kong dollar, where it used to be 7.7 to 1 for like every year.
Yeah.
But okay, well, Amelia, this is your cup of tea. So you've got the microphone here. What are you thinking on the U.S. dollar, and what foreign currencies would you be thinking are the more favorite?
Yes. Well, looking at the US dollar, it's definitely a meltdown. We had this since March, April, and May, those 3 months, the dollar trading range got tighter and tighter and tighter. Obviously that giant move there, that's March, where we spiked to like 103. That was the day before California shut down. And then we, obviously we've come back. We're in a trading range where the bottom was around 98.30 area. And when we broke 98, the figure to the down, it was really a free for all. And as that was happening, that's like a mirror image of the S&P 500. So that major down leg in the dollar is S&P 500 rallying, really. You look at the two together in the same direction. And as the risk seeking occurs, so see that down leg in the dollar, that's the up leg in the S&P 500 So as risk seeking occurs, the dollar weakens. Why? Because there's no need for safe haven demand for the dollar, because risk is rallying, and the dollar strengthens, in turbulent times on risk aversion. And, and stuff, the Fed put in the dollar swap lines with other central banks to ease US dollar liquidity globally. So that helped take upward pressure off the dollar and the dollar index. What we just have to keep remembering with the dollar index, though, is that it's 57% the euro, right? So when you look at the weights, it's 57% the euro, and the euro's rallying right now a lot. And the reason the euro's rallying a lot right now is the ECB just boldly increased their quantitative easing. PEP, they call it the Pandemic Emergency Protection Fund. It's called, but it's quantitative easing. They just they just named it PEP because of the pandemic, but it's quantitative easing. And they just increased that last week by 600 billion euro and extended the duration of it out to June 2021. Germany just passed a large fiscal package last week, and that was larger, 30% larger than the market thought it would be. And the third thing that's impacting the euro, which is really positive, is Merkel and Macron talked about a big fiscal package for the European Union that would have joint issuance of bonds, okay? And so that's being discussed. It hasn't been approved yet. But remember, the entire time that the Eurozone, the European Union, has been formulated, they've all said that they would come to be a fiscal union. They've always said they will never do that. And this Corona bond kind of that they are discussing implementing is the first step in a fiscal union, essentially. Now, they don't want to say that, but to analysts, that's true. And so this is very positive euro. And so, you know, kind of to Carley's point, will the US dollar index keep melting down? Sure, if risk continues to rally, it will melt down. But if the euro turns for any reason, if they don't pass that joint fiscal package, you know, if euro comes off, then certainly the dollar index will strengthen.
Yeah, that was my feeling is that 95 level is really key for me. And if they can hold that 95, because the long-term moving averages on the dollars have not crossed yet. And so if they dip this thing down to 95 and you start seeing 98 or 99 again, it could be a deal like stocks where they dumped it for 1 month, got it back above the 3-year moving average at 2,800. And it's been, you know, upward from there.
Yeah, 95 is that March low. So,
yeah. And that's also where the 3-year moving average comes in. So it's kind of, you know, not a coincidental price, you know. So anyway, yeah, you're thinking that the euro could be the king dog because obviously it's such a heavy part of the dollar index, and it is trading above the 50 and 200-day averages now, correct?
Yes, I think you have to watch U.S. equities for the dollar index. You have to watch U.S. equities. Are they rallying? You have to watch the euro. What's it doing? Any negative headlines on that joint fiscal package is going to weigh on euro. Conversely, if they pass that joint fiscal package, that's gonna be a real boost for euro. So the U.S. dollar index will move lower. You have to watch the VIX, right? So if the VIX spike starts to creep up for any reason, you should immediately turn to the dollar index and see if it's not creeping up. And if it's not, it could, you know, that could be a leading indicator to a turn in the dollar index. You just got to watch the VIX. You know, volatility has been moving down, you know, but it's still above 20, so that's still elevated.
Yeah, but it's under 30, which is better.
Yes.
Yeah. Okay, Carley, in the commodity world, obviously we've got all different sectors, energy, metals, agriculture, obviously the financials, currencies. Where's your radar, you know, flashing a little bit right now?
So we have our eye on a lot of the agricultural commodities, and the reason being we just discussed the dollar. The dollar has dropped quite a bit in the last month or so, but commodities haven't responded yet. But eventually they will if the dollar sticks lower or heads lower. A weaker dollar is strong for commodities, and so we've got our eye on coffee, which is hovering around the dollar area. It's rare to see coffee stay below $1 for the long run. We did see it last year actually for a couple of months, but that's more of an exception than a rule. So usually anytime coffee gets down around the buck area, it's a time to maybe put something on. Coffee is a risky market though. So if you've never traded it before, it's not a place for open-ended risk, maybe a bull call spread or something simple. Right. We like the meats on the upside. There's been some turmoil there with the China trade deal and coronavirus shutdowns and meat packing plans, but we think a lot of that's working itself out, and the upside should be, at least in hogs anyway. Cattle, I'm kind of on the fence, but in hogs, I think they're cheap enough that the path of least resistance should be higher. Same in soybeans and soy meal. So those are the things we're looking for.
Yeah, as I was looking across the board, cocoa, sugar, and soybeans look like they may be trying to turn. Do you have a feeling on those 3 specific ones?
I do. So sugar, we actually had a bullish position on in sugar. We got out on Friday. It's had a nice little run, and we're just waiting to see what happens. Right. Seasonally, it actually still continues to go up for the next several weeks. So that's something that I'm, you know, even though we're on the sidelines, I do think the path of least resistance is higher in sugar. Soybeans, on the other hand, are on the cheap side. We've kind of been trading sideways for several months. And so I think a good play there is, I mean, we may retest lows just because the rally we saw last week just can't seem to, beans
Follow
just can't
through.
get out of their own way.
Yeah.
But in the long run, if you're talking 6 months down the road, I think there's a good chance beans will be in the mid nines, maybe even $10 area is possible. So if you're playing the back months, November, you may want to get positioned for something like that.
Do you look at the commitment of traders reports? Because some people were saying the commitments of traders or commercial buying in sugar was pretty good. Do you see any of that going on, or?
So I do. I watch this. I look at the COT report religiously every week. So that's something that I really put a lot of time into. To be honest, I haven't really found in some of the softs, I've found the COT report not to be as helpful as some of the other markets. And probably just maybe I'm not, maybe I just haven't found the edge there. I'm not sure. But so I don't have a big opinion on the COT report in regard to sugar. I do in corn. If you look at corn, the funds and speculators are holding really big net short positions. So at some point, what I look for in the COT report is I'm looking for extremes. Are all the specs long or are they all short? And once the bus gets too full, we start to look at the market flipping the other way. And we're seeing that in corn and hogs as well. Basically everybody's short, and eventually you get to a situation where there's nobody left to sell, and then you get people covering and short squeezing and that sort of thing. And so that's what we're looking for.
Okay, Amelia, on the currency front, we've got the euro and the yen, which are obviously big dogs in the party, but you've also got the Canadian and the Aussie dollar, which are kind of, in my view, commodity based. What's your feeling on the different currencies out there?
So as risk-seeking rallies, I knew when we got the payroll employment report, which was a big positive surprise on Friday, even though people have questioned the, they haven't
validity
questioned.
of
Yeah, I don't want to say the integrity of the data, because the BLS did release technical notes with it that are very detailed, and they have had problems collecting the data, which they've been very transparent about.
Exactly.
But there is some issue collecting the data, which they are trying very hard to correct or understand. And anyway, so it may not have been as negative, as positive as perhaps it was released, but
Exactly.
I will say anecdotally,
and
look around where you live. Anecdotally, here where I am in Florida, restaurants are booked a week in advance to go out to dinner, both inside and outside. People are very excited to be out and about again. And, so there's people out, they've seemingly kept their jobs or are, expecting to return back to their work. Mm-hmm. So maybe we've seen the very bottom of unemployment, not the unemployment rate that's lagging, but, the drop in employment. Maybe it'll slowly start to climb, even if that number last month is revised lower. But
I got one question for you. I read that the participation by households and businesses was in the 60% area, 65, 68, whatever. And also the volume was so high that it would be very hard for them to obviously absorb that. And these guys who do the estimates, they're kind of from Yale and stuff like that, right? So the likelihood that they would be that far off is pretty remote, and the likelihood that the low participation rate plus the volume would skew the results incorrectly is not a bad percentage, right?
No, it is highly unusual that every bank was so off. No bank that was surveyed, and these chief U.S. economists, at the bank, they've been doing this for decades. So
right.
It's very unusual that they all collectively would have such a big miss. So, and it's also unusual that initial job were continuing claims and initial jobless claims were rising, meaning more people were filing for unemployment, yet the payroll number came positive. Yeah. So we're not sure, but now that we're talking about it, if you're looking at event risk ahead, that could be a negative headline that comes out, the next payroll employment number, because they revised 2 months back. So you need to watch for that. There'll be a lot going on when they release the next payroll number. I think it's like July 5th, I want to say. It's the first Friday of July. I'm not sure when the holiday falls, the 4th,
Yeah.
but I want to say it's the 5th is the next payroll number. In terms of Aussie, though, risk is rallying. So it's an uncomfortable position to hold. People are like, do you go long here? I mean, it's like at 70, the figure right now, right? So it's tough to go long here. I mean, it's had a big move up, but it keeps bouncing off the 70 level. It really hasn't meaningfully broke through today. You know, the best thing about Aussie and Kiwi right now, because we call them high beta currencies, they're the commodity currencies along with the Canadian dollar. So they rally when the US dollar weakens, obviously. It's the other side of the pair, and when it's risk seeking, which it is. So equities are up in the US. So, you know, you can pretty much make an intraday chart of the S&P 500 with Aussie, with Kiwi. Aussie tracks it a little better than Kiwi tracks a little more closely. But, you know, I'm for trading those intraday right now. So I don't want to leave an Aussie position on overnight simply because of China. So overnight is obviously in the Asia trading hours is when the Asia trading session is when China headlines come out. And if those are negative, you know, you don't want to be handling that overnight. So I like to day trade Aussie intraday. So if we have a big move up in US equities, sure, I'll be long Aussie for most of the day. You know, you can start even with the futures in the morning before the market's open. You can see how the futures are moving. And the same thing with Kiwi. Kiwi doesn't track as closely, but Kiwi's been lagging the S&P 500, and it's started to move up. And it's been more positive now that New Zealand has announced it's essentially eradicated
Exactly.
coronavirus. So it's getting a boost, you know, from that as well. There's no new positive cases there. So they've ended their social distancing. So, you know, there's still room there. We had the OPEC meeting this past weekend, and they agreed to extend the production cuts. So sure, Canadian dollar CAD can continue to move down. Canadian dollar can continue to strengthen. It's going to benefit from the rise that we've seen in oil prices. It's summer driving season coming up in the US. We assume people are going to go places. We can watch the traffic congestion data across cities to see if they do, and that should impact oil. And China is reopening, and that's causing more demand for oil as well. So that all should benefit Canadian dollar.
With regards to the yen and the euro, I mean, I was looking at the 50 and 200-day moving averages. The yen is having some trouble getting above it, but the euro has gotten above it, and you just mentioned exactly why, with all the stimulus from the EU as well as Germany, which is, you know, from Germany, it's like a shocking amount because, you know, they've been very hesitant to jump into the stimulus game.
They're very fiscally prudent in Germany.
Yeah. So, I mean, would you say out of those two, the euro would be more of a favorite?
Yeah, I think dollar yen has been a tough trade. I just think it's been tough to trade dollar yen. It's usually not, but the reason why it's tough to trade dollar yen right now is because yen is also a safe haven currency, but the dollar has been, because when there's a global shock, like we've seen an external shock globally, people flood into the dollar instead of the yen because it is really the world's safest, I don't want to say safest safe haven, it's the world's first choice of safe haven asset, that and gold. And so you've seen the yen kind of be impacted, and it's a little bit off, I think, the main bank's currency trading screens right now. So I think I prefer euro. It's through the 78.6% like FIBO retracement, which is like around like 112.80 level. So we're sitting above that. And the high was back in March, 114 like 50, 114.40, 50 area. So as long as there's no negative headlines about this kind of joint fiscal EU package that it's under consideration with the individual governments, I think we can move back, you know, to that March high.
And you were talking about keeping the Aussie dollar on a relatively short leash. Is that basically your philosophy on all this stuff? Is pretty much keeping things on a short leash, meaning a day trade or something with a close stop? Or is there some that you would do more position trading on?
The only thing I do more position trading on is probably sterling. I would think everything right now, keep it in a close, a tighter leash, because you shorten and so do major hedge funds. When things are very volatile, you shorten your time horizon. So things are moving very directionally, but they're toppy, right? Everything's toppy. S&P's toppy, you know, Euro's toppy. You know, you could argue the dollar index is, you know, really low. Aussie's toppy. So how much more can all of these run directionally? Nobody really has a good answer for that, but nobody wants to fight it. So,
Yeah.
keep your stops a little closer so that you can participate, but certainly not fight it. And if a bad headline comes out somewhere sometime, you have some protection against that.
Yeah,
Sterling is a weird one because, just real quick on sterling, sorry, they're still negotiating the Brexit trade talks with the EU. So.
The prime minister has lost a little bit of popularity lately, they say.
Yeah, London is still
Course.
locked down, as I mentioned kind
Yeah.
of earlier in the call, and New York is opening today, starting to, but London really isn't. From everybody I know in London, they're still pretty locked down. So,
Yeah.
that's going to impact their economy, and they still have to do, the end of the month is the deadline for the British government to ask for an extension of the negotiation period of the Brexit deal, trade talks. So we'll see. We haven't seen any headlines, not too many headlines, because they're in talks now, but they've been preoccupied with coronavirus.
Yeah, I think you made a good point on the Aussie too, because I see that it has gone right back up to the 52-week high. So this is a neighborhood where it's kind of petered out before, and unless they come up with some very interesting reasons to take it through 70 area, obviously this is a place where you'd want to be careful with it.
Yeah, the sentiment, you mentioned the CFTC weekly sentiment report. So the shorts are building in Aussie. The shorts are starting to build in Aussie, so you just got to watch them.
Yeah. All right, Carley, the price of crude oil, my feeling was that we were going to have an L-shaped supply situation because of rig counts being down and then the fracking closing down. And then, of course, OPEC is doing a great job cutting now. So, and I thought that the demand would be V-shaped because obviously people are ridden like cages. And when they get out, they're going to want to go places. So I thought it set up pretty good for a rebound back towards this $40 number, maybe $35. We're here. Is this a time where, we might want to, lighten up or hedge or consider the concept of maybe it, consolidates from here?
Well, I think we're definitely, it's ironic because 41 seems kind of expensive right now, whereas in early March it was cheap. If you remember, right before the OPEC plus impasse where we had the price war, crude oil settled on that Friday before at roughly 40 in the low 40s, and then it opened up $13-14 lower in the low 30s, just without any trading in between from Friday night or Friday afternoon to Sunday night. And so we're basically right up there where it was before that, but a lot has changed. You just mentioned the shale oil producers have dropped a lot of their rigs offline. In fact, a lot of them, faster than we've ever seen them drop at any other time in history. OPEC has cut production. So we're right back up there at the price where we were before all of that happened. Of course, demand is still in question, but demand will come back. I think for the most part, we can all kind of agree that the shutdown was temporary, and now that we're slowly coming back online, it'll take some time to get there. But I think even if we get to, let's say, 75, 80% of that demand, we've already fixed the supply situation that was weighing on prices before. So I think we're in a position for crude to go quite a bit higher in the long run. In the short run, you're absolutely right, though. This is probably a good place for the market to pause. We've almost filled the gap, not quite, but we're testing the gap. And so I think this is a place where anybody that's long is probably going to want to peel something off and hedge their price risk. I wouldn't be a buyer here, but I wouldn't be an aggressive seller either. Anything that you play on the downside should probably be limited risk and well hedged.
Yeah, a trim or a hedge at this level is not a ridiculous thing to consider.
Correct. Yeah, I agree.
Let's turn to the metals real quick because it's had a heck of a time getting above 1,800 on the gold, and some of the mining shares, have petered out a little bit, but might be a little early to throw the bull case totally away. I've also noticed that the coins, people have been paying like $150 above spot, so that's obviously a frothy number. But do you feel like? And then, of course, the longer-term moving averages are well underneath the market. So are we, what are we doing with gold?
Well, from a charting perspective, we're actually trading in a sideways channel in gold. It doesn't feel that way
Mhm.
because some of the moves have been pretty dramatic and they've all taken place on 1 or 2 trading sessions.
Mhm.
But we seem to be holding support. I mean, on Friday we tested support. Today we're bouncing a little, and so assuming that that occurs, and also we have already mentioned the dollar is weaker. That'll support commodities, especially gold. Although the dollar gold correlation's been a little bit wacky this year just because of all the things going on. Eventually that'll come back in line and that will be supportive to gold. I believe it or not, I'm not super bullish gold. I think that we're getting to a situation where, like, if you look at the COT report and you look at sentiment readings, basically everybody's bullish, and usually that's when you start to worry about the ability of gold to hold gains. I do think we have at least one more run up, so I'm thinking 1800, maybe 1850, but at some point the longs are, we're just going to run out of buyers, to be honest, and at some point we'll fizzle, kind of like if you look at gold over throughout history, it has miraculous rallies, but when they finally run out of steam, they fall hard. And so I think we might get something like that at some point this year, but probably not right away.
Yeah, the gold shares have definitely not jumped on the train because GDX is in the 30s, and the last time gold was up in the 1900 area, it was twice that. So it's interesting to see that the gold shares either have a big game of catch up to be done, or are telling us that maybe the prices on the spot have gotten a little bit frothy, huh?
Makes sense.
Yeah. On the silver, I find that very interesting because I think there's more of an industrial use there, and they did dunk it pretty good. But now that it's above 16, 17, it might be a deal where the actual risk to where you would get out is a lot closer than on the gold.
Right. So we'd been watching the gold to silver ratio, and I think it was about a month or so ago we started coming out and talking about how it was at an extreme level. It was over 100 for the first time ever, maybe, or at least in a very long time. And so it's normalized somewhat, but I do still think that silver's underpriced compared to gold. So even if gold doesn't necessarily fluctuate much from here, silver should still, I think, continue to find support from, like you mentioned, industrial uses, and also from a weaker dollar.
Is it in the batteries at all or something like that? Or is it something to do with the cars? Or
Oh, you're talking about
I don't know.
like Tesla, and
Yeah,
I'm
yeah.
I'm not so sure. I
You're
mean,
not sure.
it is, but I don't know if that's going to be a huge price driver. But yeah, I don't know, to be honest.
The silver on a longer term chart, seems like this 19 to 21 area is obviously some kind of a resistance zone. Do you feel that if we could ever get above the 2021 area, that an acceleration phase could occur?
It could. Silver's really a bandwagon market. It's, if anybody that was trading in, during the financial crisis knows that once people start buying silver, sometimes they just don't stop. In 2011, we peaked out at about $50 an ounce, and I don't think we're going to get anywhere near that anytime soon. However, I do think that if we can get above, like you mentioned, 2021, then we should have a pretty nice run into like the mid 20s. To be
Mhm.
honest, we'll have to wait and see what it does there. We'll probably turn neutral around 2021, just kind of see what happens. But if it does break through, I think you're right. The bandwagoners will jump on, and it could get a nice run.
Now, copper got nailed because China obviously had some tough times, and of course, the economy looked like it was going into a depression. So we went down to two area on the copper, and we've come back and taken out the 250 level. But this neighborhood of 250, 260 has been a tough neighborhood. Do you think we might get through it in copper because of the economic bounce, or do you think this is more of a place where you got to be concerned?
I think copper's probably seen most of the easy money on the upside's been made. I think we're going to
Mhm.
start to run into trouble between here and 270. So
Mhm.
I think you're right. If you look at a long-term chart, copper gets really, really comfortable around 270. So
Mhm.
it'll be hard to get much higher than that, I think.
And then it may meander for a while.
I believe so, yeah.
Yeah. All right, Amelia, we talked about the currencies, which obviously you focus on very significantly, and I brought a lot of good information to the people today on it. Outside of the currencies, are there some things that you're looking at that you'd like to share?
Currencies are really my main focus. I mean, I agree with Carley on gold. You know, as the dollar declines, it should help gold. A lot of people, though, are already long gold, as I kind of mentioned at the start. It's like the safe haven kind of last resort. And so when there's global turmoil, gold is really a safe haven focus. So I think it does have legs to the upside. It also depends on how volatile the global news cycle is going forward. You know, is there another round of virus, or is there real tension between U.S. and China in terms of the economy or the trade war headlines that are coming out? You also have to kind of watch what's happening in Hong Kong, because the protests are resuming there. And you have to, every Brexit negotiation goes to the 11th hour. And the problem with that is when there's major 11th hour decisions between large economies, you know, that can create volatility in the market too. So there's a lot of event risk on the horizon. I mean, if you just think, there's also, I mean, the US presidential election in November. I mean, that almost seems like, you know, there's just so much happening already this year, and so much that's going to happen for the rest of the year in terms of important global events that, you know, yeah, you probably are going to want to stay invested in the safe haven.
Now, as far as the currencies are concerned, a lot of that also can affect international stocks, like VPL, which is a Pacific ETF, or EEM, which is your emerging markets, or FEZ, which is Europe. Do you feel that there could be longer term opportunities in the international stocks if we were to see further dollar weakness, which people sometimes feel is a positive for the internationals?
Yeah, I mean, we have to look at, I mean, global rates are in the G10 economies. They're pretty much zero everywhere. So no one has like a yield advantage anymore.
Right.
They're going to have more of an advantage. The advantage is going to lie with who passed the quote unquote fiscal packages that are working for their economy. So just right now, we're kind of in the rallying phase of like fiscal packages are announced and that's good for the market. So it's rallying. We have to wait, and we don't have these answers now until see if these fiscal packages are actually, what the measures that they've taken are actually working in the economies. And we'll know because the economies will start to come out of recession economically, and the data will start to improve. And the data, not now, but the data is bad everywhere, right? So every major economy is in recession right now, and the data are going to be bad for the next couple months. But as they start to emerge from recession, it'll kind of be important who emerges first, which economy, the strength of the emergence from, you know, the recession, and that'll start to matter. The thing about the global rally, or the risk rally in the United States, that did start to spread globally. So it was, you know, European stocks were up. So the rally has, you know, kind of moved out of the US and been global right now. Then I think right now economic data doesn't really quote unquote matter, because obviously we're talking about the stock market is divorcing itself from the bad economic data. The two are diverging. But eventually that may not be the case when we start to emerge, you know, maybe 3 to 6 months from now, and we start to see whether the measures that we took in the individual governments, if they're actually making a difference for the actual people of, you know, of the economies as they emerge from the recession. So I think that'll be an interesting thing to watch. I don't remember in my career having, I don't remember there. I mean, I've been in the market since '98, and there's really been nothing like this, a coordinated global shutdown that happened instantly. So if anyone's saying to you like, oh, this will definitely happen, or I think this will happen, I mean, nobody really in the last 20 years in the market has seen anything exactly like this. So we're kind of in uncharted territory with the global shutdown and reopening. I mean, emerging markets, you just have to be careful. You know, you can watch emerging market, the flow data into emerging markets and equities and bond yields, and that'll be important. But it's tough right now for EM because obviously, coronavirus really hasn't peaked in most EM countries yet. They're not necessarily past the worst of it.
Yeah, the central banks, with regards to the debt to GDP, the crisis allowed them to get the authorization to re-leverage the entire world. In other words, there's no way that Congress would have gone for this kind of printing presses if there was not a crisis. And the Fed balance sheet was a very relatively small percentage debt to GDP before this. So it was pretty obvious to me that they were going to expand the balance sheet dramatically, because even with the jump, I think they're only going to be at like 40 or 50%, as opposed to Japan, which is way over 200%, and in Europe, it's way over 100%. So when people realize that our debt to GDP is still way lower than Europe and Japan, I'm wondering out loud if that might be the fact that maybe stops the dollar from dropping, as they realize that the dollar is the one-eyed man in the valley of the blind type thing.
It could. You might be right. I'm not saying, that could be the case. The other thing that could be the case too is, obviously the United States, we're a single market, where Europe is not a single market.
Mm-hmm.
And so there's different, obviously different bond markets across, differ from each other by a lot. So, you can see the same thing that happened back in 2008 with the Greek debt banking crisis. The southern states aren't recovering as fast as the northern economies, and this causes, unevenness and difficulty as they navigate forward. The other thing is, the U.S. economy usually bounces back pretty quickly, quicker than other economies. And don't forget, the United Kingdom was the United States' economy was strong heading into this crisis of coronavirus, but the UK was already on its back foot because of the Brexit negotiation. So business fixed investment in the UK, business investment in general, had just started falling into negative territory even before coronavirus was on anybody's radar screen. They're going into this coronavirus shock on their back foot as an economy already. So that could hinder their recovery going forward. How countries come out of this will really matter. And for the US, I guess the policies taken after the election in terms of stemming the budget deficit, the tax policies and things like that, will they slow the economy? Have to be very careful with that, whoever is in charge.
Yeah, the other thing very positive for the U.S. is the demographics. Our millennials are between 20 and 37, and they're going to be spending their brains out in the next 10 years, as opposed to Japan, who people think QE didn't work because their economy's been so slow. They have such an aging population; they can't grow an economy. They can't grow an economy because they don't have the workforce.
Yeah, Japan is it's tough because of its demographics.
Yeah,
that's true.
All right. Well, I'm going to turn it over to Carley to see if she has any other markets that she would like to discuss. Or, here's a question we were going to ask, and let's just finish up with this. Carley, the question is, I feel like Alec Trebek. The question is, what styles or trading methods have you felt are, have you had the most success with? Trading styles or trading methods?
Okay, so I'm a big believer in option trading because I think it tames the futures markets. Futures markets are highly leveraged, and a lot of retail traders have a hard time managing that leverage and risk. So I tend to encourage people to take a look at options. And with that said, I also understand that options are generally priced to lose. So if you're just simply buying options all over the place, your odds of making money are pretty slim. Every once in a while, you'll catch a big move, but in the long run, it's a tough game. So we encourage our clients to, for every option they buy, sell at least one, maybe even two, to pay for it, depending on the situation and the account size and risk tolerance and that sort of thing. So we tend to favor option spreads, especially in this particular environment. Short option trading did not work earlier this year. In fact, anyone with any naked short options just had a horrendous time. Yeah, horrendous time. So we've really started encouraging people to trade spreads that do have limited risk. Even if the strategy is premium collection, make sure you have protection in place, because if you don't, that 5% chance of losing could wipe out your whole account, and that's no fun. But we've had some luck recently, just because the option prices are so blown up with butterfly spreads, and so we've been able to get into some markets like silver and crude oil with recommendations. Basically, your risk is roughly, like for example, in a crude trade that we had recommended earlier this year, you could get into a $10 spread. In other words, the payout is roughly in the $10 range. Your risk is like $500-600, and you could make, if you held to expiration, everything went perfect, you could make 5,000. So there's a really big risk to reward ratio. The downside of a butterfly like that is you kind of get trapped in the trade, because you can't, your delta is low, and you have to wait for time value to go. So it's not perfect, but it's a good way to get in with low risk and a big potential payout. So I'm a fan of, to answer your question, I like the idea of option spreads.
Yeah, if you're bullish or if you want to be long volatility, you do a debit spread, and if you want to be short volatility, you would just do a credit spread, basically, right?
Yeah. Yes. Correct.
And a lot of people who are listening, they hear butterfly and they want to go get a net, so they're not sure about what we're talking about. So that's the purpose of, at the end of the broadcast, to call Carley up and let her give you the 411 on some of this language, huh?
Exactly.
All right. And Amelia, again, let me repeat the question here. What styles or trading methods have you had the most success with when you're doing the currency?
I'm a spot trader normally, when I know some people don't like that in retail. But now that interest rates for currencies especially are pretty much zero almost globally, or across the developed economies currencies, we've seen futures and the spot prices kind of converge. So it's better, you can just trade the futures, and I think that's a really good idea right now. The currency futures, of course, it's still very risky, and as we talked about earlier, I'm keeping my stops just tighter, and my dealing time frames short, because there's just a lot of risk out there, and a headline can come at any time. So I do like the futures.
And a lot of these markets have had a big snapback, and so after a big snapback, the easier volatility to the upside might have been chewed up a bit.
Yeah. I mean, we've had a big directional move in all of the currencies and the S&P, so and a lot of the equities. It doesn't mean it can't run further, but we don't know how much, so we just have to be careful.
Sure. All right. Well, we're closing up, Amelia. Why don't you again let the listeners know how they could contact you and get more details on what's going on at your company?
Sure. So you can find me at my website at www.marketcompassllc.com. Follow me on Twitter at Amelia Bourdeau. My last name is spelled Bourdeau. It's just my name for Twitter. And IG, Instagram, my account is Market Compass, and you can watch the stories. I do like intraday updates there and on Twitter. But if you want to get on my free research, you can go to my Market Compass website and sign up right on the site.
And there you have on the screen right there, marketcompassllc.com. So you could visit that website very easily. And thanks a lot for being here, Amelia. Obviously you added quite a bit to the broadcast here, and people learned quite a bit, but they can learn a heck of a lot more if they go to the website.
True.
Carley, yourself, again, just how can people get a hold of you and get more details on some of these option strategies you're talking about?
Sure. So my website is decarleytrading.com. It's spelled DECARLEY trading.com. And you'll actually find about 40 or 50 educational videos that are free. We also have several articles that we've written. And if you're interested in learning more, I've written multiple books. Higher probability commodity trading includes like market analysis, strategy development, that sort of thing. And I have a new book coming out next month called Trading Commodity Options, and it's going to cover butterflies and all that other fun stuff we talked about today.
Great. So
I can go to the web. I got an advanced copy. I shouldn't have said that. Excellent book.
Well, thank you.
Yeah, Carley's been doing this a very long time, so it would be a very good read for anybody who wants to learn more. And decarleytrading.com would be the place to go.
Absolutely.
Each week I do give a market update via email, and I go over the stock market, the bond market, interest rates, the whole 9 yards, and I give my opinions and my observations. So if you'd like to receive what I've got to offer, just simply email us at optionprofessor gmail.com. Okay, this was a great broadcast. People should have learned quite a bit. And of course, there's a heck of a lot more to learn if you go to the website. But I really was happy with how it went. I hope you guys were too. And I'm going to turn it over to David so he can thank you guys as well for being here. And hopefully we can do this in not too distant future.
Yeah, great discussion today. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app. You can also go to TimingResearch.com to get access to the recording of this episode as soon as I can get it posted, as well as any of the past reports or shows. And just want to thank my guests again for today. Carley Garner of thecarleytrading.com, Amelia Bourdeau of MarketCompassLLC.com, and the Option Professor at OptionProfessor.com. Thanks, everyone.
Thanks so much for your time.
Thank you, David.